Hello, my name is Brian Overby. I am the author of The Options Playbook, and welcome to this edition of Options Guy TV. All right, so on Monday, we determined that this week we're going to talk about short spreads. So we looked at two short spreads in two different underlines. We did a speculative short call spread around earnings in a company called Skyworks, which is basically attached to Apple. And then we came out and looked at a less speculative trade in the SPY going out further in time. And that's kind of been our theme here on Options Guy TV. We'll look at how to speculate with a specific strategy and also how to more so invest with a strategy. Okay. Now, one of my favorite strategies are short call spreads and short put spreads. So I want to do it some justice. Now, we went out and looked at Skyworks, and I'm going to start. First of all, let me switch my screen here. Give me a second. And I'm going to start by looking at the Skyworks trade. On Monday, they announced earnings, and they announced after the close. Now, Skyworks it makes chips. Their main client is Apple, and they basically do a lot of the behind the scenes work on the iPhone. They have a few other clients, but honestly, they would be in a lot of trouble if Apple ever left them. I don't know if there's any hindsight to that, whatever. But what's usually interesting with Skyworks is that a lot of times Apple will announce earnings and you'll usually see a sell-off in it because a lot of times there's a run-up going into the earnings. Apple announced last week, and they were lackluster on their earnings. The stock reacted that way. It was down not even the expected move, about half of that. I think it was down about $4 or $5 on the open after they announced. And a lot of times, if Apple announces and does really well, Skyworks usually rides that wave a little bit better than Apple does. So we just decided, okay, we're gonna ride this theme where Apple had a lackluster earnings report, and so we were going to get short on Skyworks. So how do we do that? Well, around an earnings report, I'm always trepidatious to do short call spreads and short put spreads, mainly because the risk reward isn't that awesome, right? If we look at our trade, and I'm showing it here on the Trade Hawk options grid, what we did was the August 11th expiration. So we did this totally on earnings. They announced on Monday these options expire in 2 days. The IV has dropped off precipitously. It was like around 70% implied volatility. It's now down to 38, which I'm highlighting here on the Trade Hawk software. We went over the expected move out of the money when we set up the trade, and we sold it right around where the one standard deviation move is. I'm going to highlight that too. So whenever we're doing earning trades, we're always going to look at the expected move, which is just looking at buying the long call and buying the long put on the most at the money option contract for that expiration. And usually, well, I should say for the shortest expiration, we happen to use that expiration, but for the shortest expiration. And the expected move is always a little bit less than the one standard deviation move. So the one standard deviation move, it kind of makes sense when you think about it. I look at the expected move and I think of it as an over/under, like on a football game or some betting line in that aspect. I don't like to throw the term betting around when I'm talking about option trading, but the math that's behind the options marketplace is very similar to math that is used when bookies are booking spreads. And so if you think about it, a one standard deviation move, usually the stock will finish beyond the one standard deviation move only 16% of the time. So there's no way that a one standard deviation move would be considered as the over under, if you will, right? Because there's there's low probability that it's going to go beyond that one standard deviation move by that expiration date. So the expected move, which means you buy the at the money long call and you buy the at the money long put, it makes sense that it's going to be less than that. And it also makes sense that if you're buying a long straddle, that means you're taking the over, right? You think it's going to move more than what the marketplace is expecting. If you sell that at the money straddle, you're basically taking the under. You're saying that I don't think it will move as much as the marketplace is implying. And it's that simple. So obviously, if you explain it this way, it's much easier to understand where the expected move after an earnings lies relative to things like one standard deviation move. Okay. So with all that said, we went out to a one standard deviation move. The market actually from the earning announcement on was down. It was down on Skyworks. It was down after the close as soon as they announced, and then it continued on down. And if I actually look at the chart before I pull up the trade, if I look at the chart, you see here's where they announced earnings. Strong move to the downside. As a matter of fact, this is the 200-day moving average. Interesting area right in here. It's very obviously very choppy stock, but it can have strong upside. Now, comparatively to Apple, Skyworks has underperformed where Apple has exploded over the last year. So right down around here, they disappointed on earnings. 200-day moving average, someplace that would be interesting, especially down around in this in this range, but that's for another day. So if we go back and we look at the options grid again, and we look at our trade, now here's one thing that I do want to emphasize. We are on Wednesday. We have 2 days remaining to expiration. Right now, when we put on that trade, and I'm going to look at my screenshot over here of the day, the underlying stock on that day, 118, 120, okay, was at 110. It's now at 107.85. It's down. It's not down immensely from where we were at. Does that make sense? Yeah, it was 110. I feel like it was down more than that, but let's look at the chart here. Oh, yeah, I guess so. If I look at, this is where the earnings announcement was, right in here. So we did get down all the way down to 105, and now we're bounced back up a little bit. All right. So with that said, I don't want to leave this risk on the table. And I think that's going to be the moral to the story on the Skyworks trade. And there's not much to talk about. It was a winner from the beginning. Could have closed it out on the open on Tuesday after the earnings announcement. But right here, we have the risk of the 118. And right now, we're actually showing it at 10 cents on the ask and 0 on the bid. So if I were going to do this trade, I would actually close this out. Why not, right? So you have 2 legs of the trade. My order would be, and I'm going to remove this leg. I'm highlighting the short spread, but I'm going to remove this leg. My order would be to buy to close. Now, I don't have the actual position on in this test account, but I'm going to say buy to open, and I'm going to try to buy this back at a limit price of 5 cents. I want to take that risk off the table. It's not a penny wide spread, so I can't actually buy it back at a penny in this underlying. I'm pretty sure that I can't. I don't see any penny wide spreads anywhere on any of these trades. So I'm going to have to pay a nickel, but I'm going to happily pay that nickel. I'm going to remove that risk. And if anything, I got a chip in a chair, right? Who knows? Maybe that stock takes off and flies up towards the long strike, which is the 121 strike. So just let that option contract expire worthless, take off the risk on the 118, and mainly because we have 2 full days remaining in this underlying that I'd have to worry about. So I want to take that risk off. We sold it for 35 cents, and whenever we make at least around my number usually would be like 80 cents. Like, for example, if I sold it as long spread for $1, I would want to buy it back when it's 20 cents. That makes it a little bit more realistic when you talk about a bigger dollar amount. But if I can buy something back for a nickel or less, I'm always going to do it. Just always. Just don't even think about it. Don't worry about anything. Don't lay down until the urge goes away, right? Just buy it back because you want that risk off the table as soon as you can possibly get it. And it's never worth a nickel to that even though the probability is extremely high, it's going to be below that 118 line. I still just take off the risk. Okay. So the next trade, and I think I'm going to switch. I'm going to switch here a little bit. So let's pop up and pull screens over. Just a lot to talk about today. All right. I'm going to pull up my so now going forward, as we're learning here on Options Guide TV, I am actually going to share the notes and the screenshots that I did on Monday for that show. So what you're going to see now is a static screen of the TradeHawk software. This was the trade that we looked at. Like I said, Skyworks was at 110.11. We did it for about 35 cents. So now I'm going to scroll down. That trade's done, off the books. We closed it out for 5 cents. We're going to move on. Now, if we look at what we did in the SPY, when we looked at this trade, and I kind of screwed up the screenshot a little bit, but we did 3 points wide, mainly because we did 3 points wide in Skyworks, and we wanted to compare similar spreads. We went out to the 462 strike call, and we paid 90 cents for that. Now, if you can take risk off the table, you take it off the table. Bottom line is we went all the way out to September. So I don't mind letting this trade ride a little bit, but it has gone fairly good in our direction. In other words, the market hasn't performed very well since Monday. So we want to look at that trade and just see where are we at in the short term on that trade. So that's what we're going to do. So I'm going to exit this screen. And I'm going to come back and go to the TradeHawk software. And then we got one other trade that we want to look at today too. So let me get the SPY up and running in our grid. And the expiration date that we had was, let me check here 1 second, was the 22nd of September. So September and October, we talked a lot about the fact that September and October are volatile months. August leans into that month a little bit, I have to admit. So August, it's just amazing how even on August 1st, we had a drop off and a rise up in implied volatility. Now, thanks to the downgrade of the US debt, which still kind of confuses me a little bit. But with that said, the market reacted poorly to that. And it seems to kind of have the marketplace on edge right now. So here is the 22nd of September. And let me get this set up before we actually look at this trade. Okay, so 462 was the strike that we sold. So I'm going to click on bid and I'm going to put in the exact trade. So 462 is the bid. That's where, 462.50 I hit, 462. That's where all our risk is at. So that's $2.53 right now. But that is the bulk of our risk. And then we're going to go out to the 465. We're going to click on that ask, and we're up a quarter. Less than a quarter, 15 cents. So I don't want to do anything with the trade, but it's that simple. I just see it. If it would have got cut in half in a couple of days, well, maybe I'd think about getting out on the trade because we have such a long way to expiration. But we're feeling very comfortable with the trade. Market is down. We've already made it a decent amount. But once again, we did it for 90 cents when we put on the trade. So if I can buy this thing back for 15 cents, even 20 cents, I'm going to just take the risk off. That's what I want to do. And if it does start coming our way, well, we're going to keep this one on the back burner. We're going to keep this show in our little notepad over here. And we're going to come back. And if the market does start trending up towards our 462 strike before we get out of the trade, well, then we're going to look at adjusting the trade. And we'll talk about that when that may happen. So we have an adjustment. All right. So I'm going to go back to, well, actually, I don't think I need to do that because I just have the strike. So let's stay here on our trade grid and let's just type in the USO. All right. So on my screenshot on the USO, we did something that was interesting. It was the theme of the week was long calls. We looked at a deep in the money long call on Charles Schwab. And then we also looked at an out of the money, more speculative trade on USO. And because we were doing out of the money, even though we were kind of trading a breakout that we were looking at in the chart. Um, we went out further in time, and that's was the theme of the week. In that, if I'm buying out of the money options, I'll have a tendency to err on going too far out in time, just because of the way the curve is on option contracts. Now, if I'm speculating on an earnings and I'm doing it just for earnings, expiration and standards of which expiration you're going to buy is totally up to you, because it's a purely speculative bet. But if I'm buying it more so because I'm seeing something I like in the chart, well, that's a different situation. I want time for it to play out. I might not stay in all the way to the expiration date, but I want to buy an option contract that has some delta. And if I go out further in time on out of the money options, I get more delta. And also and has the ability to let the trade play out. In other words, I don't have to worry about time decay as much. And hence the reason why we went a little bit out of the money and we bought the 75 strike call. Okay. So the trade that we looked at, and I'm looking over here on my notes, was we bought the September 15th. So let's get to that strike price. September 15th. So we got 37 days remaining on this trade. So it's still a good chunk. And then we also bought the 75 strike call. So let me remove this trade down here in the Trade Hawk software. We're going to hit buy on the 75 strike call. We paid $1.40 for that trade. So we're up $1, solid trade. Normally, if it was like 280, that means that we would have doubled and I would consider getting out, right? So we bought it at 140. We could sell it for at the midpoint. If we can get the midpoint, we can sell it at 253. At 280, well, then we're looking strong. You would really consider getting out. So what's an alternative to getting out? The alternative is that we might sell some premium against it. We're still a little early in the cycle, so I don't necessarily need to do this, but the trade is fresh, and I want to show the trade, because this is what I will have a tendency to do on trades where I'm trying to play a breakout. Okay, so let's look at the chart in USO. We'll stay here for a second, and I'm just going to kind of highlight what we saw in USO. This area right here was important, right? We had our ducks in a row. This is a 400-day chart. Yeah, I'll keep it on the 400-day. And we have the 20-day moving average that crossed over the 50-day. That was good. Then we had the 20-day cross over the 200-day. That was better. We see the 50-day coming up towards the 200-day, and that would be best, right? So as far as golden crosses are concerned and moving averages, you'd like to get our ducks in a row. So you need these things to happen to try to get a little bit more bullish on the marketplace. This area we kind of highlighted, and there was a lot of chop trying to break through that high. And now we have a high right here and a high right here. So in this range, we clearly had a breakout. And it did what we were wanting to do. But also look at this precipitous move. Like, USO does have the capability of making these strong moves, but there's always chop in the marketplace. So now let's go back and the chart that we really want to look at that really drove this trade. So I'm going to take a second here to switch over, because I don't have futures quotes here inside the TradeHawk software. So we're going to minimize that down, and we're going to run over and look at Yahoo Finance, and we're going to look at a chart in Yahoo Finance. So 1 second here. Let me find that. Pulling that up. Full screen. Boom, baby. Here we go. This was just beautiful, honestly. So this is a chart that goes out over 2 years in time. And mainly, I just wanted to highlight that to kind of show the general flow of oil. And once again, you got a big run up and then chop, big run up and then chop, 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 gradually going higher. So one thing that was good in this area is that your lows weren't as low, right? You're getting higher lows on the way up, but then again, we got the chop. It's a commodity. It's not a stock. You're not going to have something like NVIDIA coming out with a new chip and the stock goes up 200% overnight. Oil is always going to trade with a little bit of chop. And guess what? Recently, we've had a very strong move to the upside, much like we did here. Expect a little bit of chop. This area we were highlighting as an area of concern on the upside after we got the breakout. We were talking about it right in here. And so this chart on crude oil, on the crude oil futures in the mercantile exchange, was more of a driver of the USO strategy than the actual USO chart in my mind. Also, geopolitical concerns, economic issues, just a lot of things. Just started to see that rally in oil. Okay. Up here, 84, we're right at this range, a little bit of nervous, expect a little bit of chop, could happen. Don't expect it to blow through this level and go all the way up to the next level and continue this real strong move to the upside. It may get there. I just don't expect that to happen. So, as an alternative in the USO, I would think about either selling it if we got to the 280, and now I think we'll go back to the TradeHawk software, or an alternative is still bullish in oil. How do we stay bullish but take off some of the time decay features that a long call option has? How can we hedge against that? Well, we roll it into a long call spread. So here we go, TradeHawk software. Let me pull that all the way up and get to the trading pit tab. All right, so here we are. We have our trade up. Once again, I'm going to highlight that nothing's meant to be a recommendation here on Options Guide TV. The biggest thing is that we're trying to learn. And one of the things that we're trying to look at is how to adjust trades, because inside the options playbook, we talk about all the different strategies and all the setups, but we don't have live markets that we can highlight adjustments in. And so the playbook gets a lot of accolades for summarizing what you need to consider when you're setting up a trade. But every once in a while, if we ever get anybody that actually puts a bad review in Amazon, it's always about the fact that you're not telling me how to adjust. And that's just such a hard thing to do without live markets. Well, guess what we have here on Options Guide TV? We have live markets. Okay. So I might not do this right now, but let's just talk about the adjustment anyways. 75. What was our upside? Where do we think that underlying may go? Let's look at the chart again, because we don't want to sell anything that it's going to necessarily blow through the strike, right? So we could sell to 78. That's a high area that was recently reached. We're in new territory after this breakout here. So where are we going to stop next? Well, I don't mind 78, 79. So I would consider either of these two strikes. And it's really dependent on how much premium we can bring in. Because we have $1.40 of risk, I'd like to get a lot of that risk off the table. So let's go back to the options grid. And the 79 is trading for 96. Guess what? We paid $1.40 for this option contract. I like the 78 better. I'm taking more of my initial risk off the table. So in this instance, I don't mind that, but I'm only giving myself 3 more points of upside. And now we're going to get really crazy. Because we have so much time and the trade has worked out so quickly, I would probably look at doing this on a shorter term basis. I don't mind doing this trade, and then I'm just going to do it, and I'm going to let it run, and I'm going to set an alert. And when we get to 78, 79, then I'm going to consider taking it off. Our short call is going to hurt us a little bit, but we brought in a lot of premium. The long call will definitely react better than the short call will, and this would be my hedge. Okay, so let me click on this one. And this was the buy to open. Okay. And so in this instance, we're going to take off a lot of our risk. Let's just put it sell, because we're already long in our account. In theory, sell would be 125. So getting almost all of our money back. And then you can just let it ride. It's that simple. It's really how much you want to manage it. If you are looking at a shorter term situation, well, then let's go all the way back. And I would probably look at going on about 15 days, 16 days, August 25th. Okay. And let's see how much we can get on the 78 now. Get 58 cents on the 78. Well, let's do the midpoint. Let's do this right. And 78, we're going to click on the bid. 50 cents. Yeah. Not bad, right? But now you are covered, but you have a lot more work to do. You're going to have to watch this trade. You don't, if it blows through the 78 trade, I'm going to have to roll it. I'm either going to, or I close out the whole trade. You're still going to do very good on the trade. You still got a profit. You're going to do better overall. But if it gets to 78, 79, I am going to roll that up and out. So it's a lot more maintenance if you do the shorter term trade. But think about that. You're getting 58 cents on a 25 or on a 16-day option contract. August 25th expiration. That's why I said 25, but 16-day option contract as opposed to going all the way out. And I think we still had like a 37-day option contract. You're getting a good chunk of that. So it is tempting to think about doing it this way. Gave you a lot of alternatives there. And it's really about your time and your willingness to manage it and how you want to approach the trade. Obviously, the simplest thing to do is, well, our goal was to be able to sell this thing for 280. We can sell it for 250. Maybe I just get out. Right. That simple. All right. So we are getting to the end here. We have a lot of questions that we might. Oh, as a matter of fact, I see we have quite a few questions here. A couple of them have popped up. So let me run in and do these questions real quick. Like, okay, at this point in Skyworks, if you had a contract, example of 5, would you consider closing 3 of the contracts or leave 1 or 2 contracts to see if you can make it a bit more money? Okay, so let's say instead of 1 contract, which we always kind of look at a 1-to-1 basis, we keep it as simple as possible here on Options Guide TV. If you had 5 contracts, would you close out half of the position? No, not in that scenario, because you're making you're as close to the maximum as you possibly could make. We're paying 5 cents. I would like to be able to pay pennies, but that expiration didn't seem like it traded in pennies. Like you can see here in the USO, they definitely trade in pennies. It's that simple in that I see pennies, right? 103 by 119. This is a penny underlying that trades in pennies. Skyworks just doesn't quite have the volume as much, and it's not in the penny pilot program. I think all of them should be. It helps market makers by keeping them trading in nickels as opposed to pennies. But that's a conversation for a different date. So if I can buy that back for 5 cents, I'm going to buy it all back. All 5 of them I would buy back in that scenario. Okay. Next question. Let's check it out. When thinking of your exit on the long call, do you decide your exit point based on the overall return of the trade, or do you have an exit number in mind when you place when the original number is paid? If I'm buying an out of the money option contract and I double, I'm always thinking about maybe getting out at that moment. If I'm down half on that position, I'm also thinking about getting out. Those are just general rules. Now, some people might make the argument that you should let your winners run more, and I don't have that. I don't mind that. So one of the things that I would look at if I was going to determine after I've doubled is what we just did today. Look at the chart. Look at that underlying stock. Look at how many days you have to expiration. And that would affect my outlook on a winner trade that I had. So in the USO right now, there's a little bit of nervousness based off of the actual chart on oil, only because I do expect a little bit of chop. But we do have a lot of time left. So I don't mind selling that call against it and rolling it into a long call spread. But the chart gives me concerns, so maybe I would get out right now at that 250 price if that's just the way that I wanted to trade. It's all about how much you're willing to handle that trade while you're doing it. In my mind, when I put it on, I always want to know when I've doubled on that long option position. And it might be total risk too. I mean, if I have 100 contracts on, I'm probably going to get out at least on 50 of them. So you get a little bit more flexibility in how you're going to handle the trade if you had more contracts on. But I always like to look at it on a 1-by-1 basis. We're here to service all. And one of the biggest things that we want to do on Options Guide TV is bring people into the fold. We'd like to get them feel comfortable. And if you can't trade 1 lots and make money, well, guess what? By trading more doesn't always help. And a lot of people think like, well, I traded this 1 lot and I didn't do so well, so maybe I should trade 10 lots. And I don't ever look at it that way. And a different way to look at it too is the allocation, how much capital you're willing to put into that trade. All right. Do we have any other questions out there? No, we didn't have a trade this week. On Friday, we're going to come back and we're going to look at a trade. And I'm going to try to find something, since we're talking about short spreads, I'm going to try something on the put side of things. So I need to find something I'm going to be a little bit bullish on Friday, and we'll try to put on a short put spread, and that will be the theme for the Friday show. Please click subscribe, ring that bell, punch that thumbs up. That always helps us here on Options Guy TV, and we'll see you this Friday at 11 a.m. Eastern Time for the next edition of Options Guy TV. Thanks for coming.